bringing us home for Finovate Spring 2026, we have the Investor All-Star Panel. Always fun to hear what our investors are thinking about where money should be going, where money is going. And I'd like to welcome them out to the stage now. Our host of this one is David Penn, Finovate Research Analyst. Joining him, we have Sydney Thomas of Symphonic Capital, Mike Hurst of TTV Capital, Tiana Pigeon of American Family Ventures, and John Bonnard of Blueprint Equity. David, over to you.
Thank you, Greg. And thank you all for sticking around for our final session of Finovate Spring 2026. Again, my name is David Penn. I'm a part of the research team at Finovate, along with my senior colleague, Julie Moon. And we've got a great panel of folks here to talk about some of the investment trends that we're seeing here in 2026 in FinTech. I'm going to have them introduce themselves, and then we're going to jump right into our conversation. Sydney, we'll start with you.
Awesome. Happy to be here. I'm Sydney Thomas, the founder and general partner of Symphonic Capital. We are an early-stage investment firm focused on AI-enabled technologies in fintech, digital health, and climate. Our definition of early stage is post-product, pre-product market fit, so not quite idea, but close to it, and excited to dig into some of the trends that we're seeing and digging into now.
Hi, everybody. We can't see you, so I assume there are thousands of you. I'm Mike Hurst. I wear a couple of hats. I've been a part of TTV Capital now, first as a founder, then as a venture partner, and today again as a founder, second time over. 13 years total. TTV Capital is an early-stage fintech fund. One of the first was started in the late 90s. We're investing out of Fund 7, which is a $250 million fund, 850 million total AUM, and everything fintech. It can be consumer, it can be B2B. About half of our LP dollars come from banks, so we really exist in that world.
Awesome. Hi, everybody. I'm Tiana Pigeon. I'm an investor with American Family Ventures. AFV is an early-stage venture firm focused on the future of insurance. And so our LP base is a syndicate of around a dozen or so different carriers, with American Family being our largest partner. And we're in the market looking for things that are, disruptive to the insurance space, as well as things that, bend the risk curve for insurance policies.
Hi, everybody. I'm John Bonnard. I'm a principal at Blueprint Equity. We're actually based here in San Diego. We're an early-stage growth equity investor focusing primarily on vertical SaaS and tech-enabled services businesses at an early stage, and we would define that as 1 to 10 million of ARR. Our connection to fintech is really, I'd say, primarily through the vertical SaaS businesses that we back. We're more of a consumer of a lot of fintech in those businesses, partners, and then we also back businesses that sell into financial services. So our current fund is a $333 million fund, which we raised earlier this year. We have $600 million under management, and we're typically writing checks anywhere from 5 to 15 million, usually leading a Series A. So excited to be here and chat with you guys.
Fantastic, fantastic. Well, let's jump right into it. And Sydney, if you don't mind, I'd like to start with you and then have everybody respond to the first question. And this has to do with the macroeconomic environment, any headwinds, things like that. And I'm curious how your perception of those, your assessment of those, is impacting investor sentiment right now.
Yeah, that's a big question, because there are a number of macro headwinds that we have the benefit of investing within right now, with gas prices surging and just a number of new initiatives happening every day by our current administration. But I think within fintech especially, we were really encouraged by the Chime IPO that happened. I don't know if that was late last year or early this year, but I do think that buoyed interest in consumer fintech again, especially amongst early stage investors. And so, are you guys investor?
I'm with you. Well, I'm just saying consumer fintech is back.
Agreed. It's back, baby. So it's been fun to continue to see growth within our consumer fintech companies and excitement from the investor ecosystem more broadly.
Excellent. Mike?
So, as I said, we've been around for quite some time now, like almost 30 years, and we try to stay very consistent and not be steered too much by the macro trends of the day or the different themes. For us, it's all about the early stage of fintech. We'll say what we're seeing that we're very excited about is AI is definitely an accelerant. And so that's allowing founders to solve problems more quickly with less people, which means they don't have to spend as much. And so we're very excited in terms of just how quickly some of these businesses are able to catch and to get scale, which is perfect for us at the early stage.
Gianna, your thoughts?
Yeah, I definitely agree with what's sort of been said. And I think when we're looking at valuation in the market, there's been a lot, to your point, on the high interest rates, gas prices. The volatility creates a lot of uncertainty with investors, and so we've also seen kind of maybe on the less optimistic side, slowdown in fundraising cycles and M&A processes. And so we definitely are keeping an eye on that and trying to make sure we're supporting the companies that we work with to have enough leeway to manage through these processes. The other thing about on the valuation side is you look at the comps from like about 2 or so years ago, and where we're trading today for fintech kind of more broadly, it's nearly half of where it used to be. And so I think there's also a dynamic happening with investors around what does it mean for portfolio holding value? What does it mean for what the hurdle rate is for new investment? And so I think when founders are thinking about fundraising, these are some of the conversations that we're having, in the market with each other around, how do we, make these new investments work?
Excellent. John?
Yeah, when you think about the regulatory component of this, we're positioned, our fund strategy really is post, I'd say, regulatory risk in a way. Like we try to underwrite. Well, first of all, we're going to have a pretty concentrated fund, and we're not necessarily a venture-oriented investor. We're more of a growth equity type investor. So one of the, what that means really is that we're not taking, venture scale risk in some ways, and so we'll tend to avoid highly regulated or more uncertain regulatory industries, like crypto, for example, is something that we've historically stayed away from. As we see regulation take form at the federal, state level, and the dust settles, so to speak, I think we'll be more apt to take risks in those types of categories. But it's funny. I always hear like there's all these headwinds, right? Like at every panel, it's like, okay, what are we doing about these headwinds? It seems like there's always headwinds, and so it's really just a different flavor of headwinds. And to Mike's point, we're seeing a lot of tailwinds, frankly. So I think it's like, what do we do with all these tailwinds in some ways versus like, how are we going to navigate the headwinds?
Excellent, excellent. I appreciate the perspective. We're going to talk a little bit about valuation. Gianna, you mentioned it a second ago, so maybe if we could start with you on this topic. And maybe you could elaborate a little bit more on the current thinking about fintech valuations. And also, sort of on top of that, what is it going to take for a fintech? What are the combination of factors it might take for a fintech to really earn that premium multiple that is so elusive often for these companies?
Yeah, I definitely think, and we're seeing this also play out in SaaS, but definitely in fintech, there's I'd call it like a flight to quality or a refocus on the fundamentals. And so we're seeing a lot of rounds that are getting done and that are getting done at the higher end of the multiples are companies that have strong core fundamentals. So think defensible mode, sustainable unit economics. They're profitable or they have a path towards profitability. And so I think those are coming back into the narrative. They've always mattered, and I think maybe nobody had talked about them or they'd been less of a part of focus a couple of years ago and kind of some of the hype cycle, but I think definitely now, that's something that is taking the center stage.
Makes a lot of sense. John, I wanted to come to you, and also wanted to come to everyone else on this topic, but John, I also wanted to add another little aspect to that, and this is the idea of how investors can apply these multiple-based valuations on businesses when some of the traditional metrics for measuring some of that, you mentioned ARR, for example, are being a little bit harder to take place. How do you see that playing into this?
Yeah, we see a lot of businesses at, call it 2 to 3 million of quote unquote ARR. And it's like, well, what is ARR in a fintech business or a business that's relying on payments for its revenue stream? And, frankly, it's challenging. I think there was a time when you would give more credit for, what you consider contracted ARR, or, for example, if a business is, let's say they're selling they're giving away the software and capturing the revenue stream from payments, but those payments are all back weighted in the year because of, it's in the like nonprofit space, for example, and they're capturing donor funds. How do you give credit for that? I'd say the market's what I've seen is pulled back a little bit on the credit you're going to get for this expected revenue, which makes it a little bit tougher. My advice to founders in this category or in categories like this where there's much more seasonality, and we have businesses in our portfolio like this, it's like, how do you adjust or defend that ARR story? Because at the end of the day, it's hard to move away mentally as investors from this like ARR multiple. And there are various ways to do it. I think it depends on the significance of the seasonality. But my advice to founders is always to get that revenue in the door and generate at least 12 months of historical revenue so that you can sort of have this foundation of a defensible story. Because if you don't have any historical data to apply to the forward story, it's going to be pretty hard for investors to get comfortable, at least at our stage and kind of the way that we think about underwriting.
Interesting. Mike, your thoughts on valuation?
We've seen a couple things change. So to Tiana's point, the last big hype cycle of 2020 and 21, companies were just hunting for top line growth. That was it. And in many cases, the business models weren't even really ever on a line to profitability. And that has changed. So it's important that what you're chasing actually has the potential to create value and create profit. When we see that, we get excited. As always, the bigger the market, the better. I will say one of the things that we love about fintech is that generally it comes with not just software, but also a service. And I think that the service component, which used to be kind of like a not great thing in venture, but we've always loved it, it creates a moat and it creates a stickiness with the client. If you're moving the money, if you're servicing the loans, if you're managing the relationship downstream with the credit card user, that's very, very difficult to rip and replace. And so we put a premium on the type of revenue that can scale quickly, build a moat, generate data that's not publicly available, and that leads to very strong channel partnerships and relationships. So when we see all of that, we go in, and ideally we get in early enough to take a 10 to 15% stake in our $1 to $10 million check size range, and then we hang on and do everything we can to add value. And 1 in 8 companies that TTV invests in wind up reaching unicorn status, which is like a great soundbite. But every one of them took a huge amount of partnership and work. And so,
I bet. Great insight there about the service and the sort of rethinking about that as a component. Your thoughts, Sydney, in terms of valuations?
I think mine might be a little contrarian in that I really don't think valuations are that important. I think that the most important thing is actually building a strong business that can return capital back to investors, but I think more importantly, especially for the founders in the room, an opportunity for you to build generational wealth for you and your family, if that's of interest. And I think that usually means you're taking a little less capital. You're probably growing maybe not 30% year over year. Maybe it's 25, maybe it's 20, maybe it's 15. Maybe you're not actually going to raise that Series D. Maybe you're actually going to sell your company at Series C. Maybe it's that you're going to, merge with another company at Series C. I just think that when you actually focus on the fundamentals of the company, there's so many different ways to build a really, really fantastic business. And I think we're seeing this now. The average company is staying private for at least 15 years. And so we're just not seeing the model that existed in 2010 to 2015, maybe even to 2016, maybe. I feel like that's actually when it stopped, though. This model of hold on for dear life, expect that the IPO happens within, your own fund life, and that everybody gets happy afterwards. It's a different world, which I actually think it requires a bit more creativity and is a lot of fun.
Very interesting perspective. And we're going to talk some more about these issues of liquidity and the investors and so forth in just a minute. I thought maybe to take just a slight step back and to look at some of the things. We've had 2 days of demos, a lot of different fintechs demonstrating a lot of different technologies. I'm curious from your opinions, and I'd like to hear from all of you on this, or what are some of the investment themes that in particular in 2026 you think are particularly resonant? And we'll start with you.
Okay, well, I'm going to echo what Mike said earlier about AI. If you're not saying AI in some way, shape, or form in your deck, you've lost the plot. So we are, and I think, for us, the rationale behind why we're so excited about AI is because of the efficiency that it can create. We're looking, which you might have alluded to through my answer with the last question, companies that are extremely capital efficient, and I think founders who are extremely resourceful. And in this day and age, if you're not using Claude to shortcut your ability to, build something really interesting for your business that might have otherwise cost you more money, more time, and more everything, what are you doing? And so we're really focused on companies that are AI enabled in some way, shape, or form, just because of the efficiency we believe it can build.
Yeah, that makes a great deal of sense. Your thoughts, Mike, in terms of themes?
Sure. We're looking hard at companies that are using AI in the application layer for very hard to solve age-old problems, which is manifesting in kind of interesting ways. Like we led a deal recently in a business called Hamilton AI, which is essentially like the planning and financial backbone of the private plane industry. And we had a number of LPs go like, what are we doing here? Private plane industry? We go, no, wait till you see what we're doing and how it's controlling the entire financial ecosystem and generating more revenue for the users and the like. And so what it takes, that Sydney touched on, is a very authentic founder, someone who knows the problem deeply, understands the data and can get to it, and maybe for the first time believes like, I can actually solve that near term in 1 to 2 years and find scale. And so we love that. We love an authentic founder and an age-old problem. You also find a lot of them in the biggest, most profitable industries. So banking and insurance, where in many cases, healthcare, where they've grown so quickly and they're so profitable, they didn't really bother to slow down and take the facts out of the workflow or what have you. And so there it is, just sitting and waiting for you. And AI can be such a catalyst for solving it quickly and effectively and within compliance. So we're hunting for those businesses, which is different. We used to say at TTV that we love picks and shovels businesses, well, which for AI would be, Anthropic and OpenAI. And like that's whatever those $100 billion rounds are, it's not quite venture anymore. So we're digging into the application layer.
Interesting. Tiana, what are you saying?
Yeah, I definitely resonate with all of those themes. And I don't know if I'd also call it the application layer or the infrastructure layer, but some like solutions that can actually help bring that into the enterprise. And so I think we're at the stage now where everyone knows the power of agentic AI and really wants to build it into their workflows, have frictionless ways to use it in the organization. And we're kind of at a point where it's running into legacy technologies. You can use it as maybe a point solution in certain types of companies, but to have actually AI native platforms where that is where all of the business activity is happening, where it's compliance native, especially in financial services, not having that be an afterthought, but actually a core part of the offering. I think we're still at the beginning of seeing how that can play out, but I think definitely companies that are trying to be the staple native software and making AI as seamless as possible and how people want to use it today.
Makes a lot of sense. John, do you concur, or is there something else you want to throw in that mix?
Yeah, a lot of the same themes. I'd say for us, it's in 2026, what I've noticed from, frankly, our investment committee is a return. I'd say a focus on quality, and in some ways, less risk appetite at the earlier stage. There are situations where it's like, hey, we could tranche this investment, get a lower price at a lower, let's say that we thought the business had $6 million of revenue and it turns out it has $3 million. It's like, okay, let's take that bet a little early and get some more upside. But what we're seeing is the preference to actually wait for that business to mature a little bit more. And I think it's probably what you're seeing in a lot of the kind of broad themes in the market where these mega funds are piling cash into the late stage kind of winners in a category. And so for us, it's really just getting back to refocusing on the narrowest part of the fairway, which is mission critical operating systems that have domain expert founders. But also on top of that, now you got to have the AI native backbone. You don't have to have started in the last 2 years, but you have to have people on your team and a culture that is adopting AI at a rapid pace. Because another thing we've noticed is it's just hard to change that behavior in an organization that isn't natively interested in AI.
Right. Right. I want to talk a little bit about founders. We probably have some in the room. We've certainly had many over the past few days, and some of the things that they're doing, some of the things they're having to navigate, whether that has to do with things like funding scarcity, whether that has to do with talent acquisition, the regulatory environment we've talked about. You've made some interesting points about the idea that AI, in some respects, maybe can help with some of the issues of talent acquisition. You maybe don't need the sort of talent you needed 5, 10 years ago. You've also talked about the idea of more money being concentrated on fewer deals in some instances. And maybe we'll start with you, John, and maybe work our way back up the line. What are you hearing from founders in terms of some of the challenges they're facing in some of those particular areas?
Yeah, I mean, I'd say that it's interested to hear from some folks who are like Mike, who's actually an operator. But from our side, we're seeing talent as less of a like I can't find people, and more of a like I can't find the right people. So you might have a full engineering team that you would think can 2x their productivity with AI, but it's not that you don't want to do AI or use AI. It's that you don't know what you don't know. And so one of the things that we're doing, we hired a chief technology officer who has been playing with AI since it came out, to really work side by side with our teams to help them adopt the latest and greatest. We'll also do roundtables of CTOs and CEOs to help them just talk about things that they're able to do with AI, and some of the challenges that they're seeing and how they're solving those problems. So I think it's really been like sort of a community effort internally at the portfolio, to kind of work through some of these challenges, and really it's really the opportunities, because you hear a lot about this stuff. And if you don't see it or you haven't seen it, you really don't know how to implement it. And so that's one of the things we've been focused on.
Yeah, I definitely agree with that. I think we've been seeing it sort of the same way of like when somebody is in, let's say the CTO role, what good looked like in that role today is completely different than what it meant a few years ago. So if you have experience, as a CTO, but it was pre, a lot of the new AI technologies today, your tech stack and what you're comfortable with is almost like, you need to relearn everything. And so what's fascinating is like there's not a ton of people in the market. There's, a large concentration obviously in the Bay and New York, but we think of the duration of time, people have been doing this maybe for a couple years, as long as it's been out. And so whoever's an expert has just been an expert by maybe another 18 months. And so it's really finding the people that have just done this one step ahead of you and connecting those with the companies that, need to your point, learn from, someone who's already done it. But the people who've already done it, I'd say it's encouraging to folks that, they're not that much farther ahead. It's just, seeking them out and being able to match that to the type of product that they're building.
Mike, your thoughts?
Yeah, I don't think that companies are struggling to raise money right now, provided that they're in sort of the right part of the Venn diagram. So if you've got a good AI story, if you're solving a real problem, if you've got a business model that at some point with a reasonable amount of scale is going to lead to profitability, there will be competition for the deal. And ideally, the founders are going to be able to pick and choose their venture investors, and they're going to pick the ones that have an unfair advantage because their LP base is a bunch of would-be customers or acquirers, or you're the 15th marketplace they've done, and they're going to give you a bunch of advantages. In terms of something that I have seen, though, is the repeat founders or the founders that just started their businesses in like 21 or 22. There was a tremendous period of difficulty in raising money, and there was a big shift in VC sentiment towards reducing burn, protecting the business, stay alive, turn a profit. And so we're having now, for the first time, maybe in the history of the firm, conversations with some founders who've built great product and are burning like 30K a month. Like, maybe we should burn a little more money. Maybe it's time to actually lean in a little bit and pour some more gas on the fire, because we think that it could be, 10x again. And so retraining and rethinking as founders about, this new reality of you do need to grow very quickly as long as you're ultimately headed toward profitability, and the VC money will be there as long as you're maintaining an increasing scale, is an interesting conversation I wouldn't have thought we would have had to have 5 years ago, but it's real.
Interesting. Sydney, what are you hearing from founders along these lines?
So I really liked Tiana's point around the experts of AI right now have been experts for all of maybe 18 months. And so what we're seeing in the founder ecosystem is you really have to have this culture and have created a culture of curiosity and also agency within your organizations. Because I think a lot of people are afraid of AI, not because they don't want to play around with it, it's mostly because they're afraid to get it wrong. Because they're afraid they don't know how to exactly query Claude so that it's going to tell them the exact right answer to their question. And if you approach it more from a perspective of play, like you just want to play with these tools, see what they could create, how they could impact your underlying business, I actually think it's a much more approachable lens for your employees. And so that's what we're seeing with the founders, which is like, how are we actually helping coach them so they can coach their team around how to actually leverage the opportunities available to them in AI when everyone's a newbie.
Yeah, makes a lot of sense. That's a great point. Earlier, there was a conversation about the duration that companies staying private for longer. And we had talked, Mike, in our previous sort of conversation about some of the problems that can result with when it comes to things like liquidity and some timing mismatches for limited partners and things like that. I wonder if that's something you could elaborate on in sort of what you're seeing from that particular perspective.
I'm smiling because I did not set Sydney up with that quote, but she couldn't have nailed it more, which is there's two things going on. One is a company reaching IPO scale is now, a decade plus for the most part. Last year we saw the beginning of the thawing of the IPO market, but the average age of the companies that made it to IPO was like about 13 years old. Only figure was, sub 10 years old from the fintech world. Anyways, but the second thing, and maybe the bigger thing, is like if you don't want to go public, you don't have to anymore. There's endless capital that will keep great businesses private, right? Like SpaceX is talking about coming out this year on IPO. That's wonderful. They are 24 years old. We've been talking about Stripe going public for a really long time. They don't need to do it. Maybe they do, maybe they don't. But so that causes issues in venture because we all think of venture as, well, it's a 10-year fund cycle. But we raise new funds every 3 to 4 years. And so you have this dynamic where an LP that loves the fund, loves the paper returns, loves going to the party and talking about how they got in early on this investment or that investment, love supporting the early stage of investors, they may have invested in like 3 or 4 full fund cycles before there's natural liquidity of the winners. And that gets exhausting. And you also wind up in a scenario where if you have a big dip in the public markets or in real estate, they'll wind up feeling very over-allocated to venture, even if they love the manager and they love the assets. And so John and I talked a little backstage, but there are a couple things that VCs could be doing. One that they're quite reluctant to is don't be afraid to sell earlier. And if there was like a true secondary market at scale, which there is for like 10 companies, but if there was for everything, you might see a little more of that, which would lead to a little more orderly return of capital to LPs, or shameless plug, what Turbine is doing, the business that I operate as CEO, is we've brought margin lending to these assets. So if your LPs and your GPs love the fund, they don't want to sell early, they want to stay along for the eventual 15-year IPO, but they want to recycle funding, they don't want to continue to sell out of NVIDIA and Amazon stock to do it, we're giving them 25% LTV loans. And so, what does that sound like? It's a mortgage or it's a margin line. And banks have always pulled back from lending against these assets because they don't understand them, they don't get access to enough data. So we're solving for that. But I will say that I don't think backing a fund and waiting 15 years every 3 years is a sustainable tenor. I think we've got to get, as a VC community, a little more comfortable with either partial secondaries along the way so that the industry can feed itself in an orderly fashion, or we just have to get smarter with credit, which we've never really had access to, and now we do.
Interesting. Anyone else have some thoughts on the liquidity point that we've been discussing?
Yeah, I'll add a point just because Mike brought it up. We were talking backstage about our strategy and how we play at this early stage, which call it Series A. I'd say when the fund was formed in 2018, there was really this multiple arbitrage you could get from investing at 2 million revenue because the growth equity funds wouldn't come down that low. They were kind of at the 10 to 15 zone, maybe 20 at the early end. And so there was just less capital chasing these deals. So you could price them, I'd say, more appropriately, and then there'd be a lot of demand and competition for those at the later stage from the growth funds. That's probably gone away in a lot of ways, but there still is a lot of growth equity funds out there that have grown over the years, and frankly, they need to write bigger checks. So we've been fortunate enough to take some chips off the table at the call it Series B stage, and I would encourage founders to do that as well, because you just never know what the market conditions are going to be like. I think the other challenge here is that as valuations have gone up in many cases, you set the expectations so high, and so you might raise at a $50 million valuation, with $1 million of revenue, thinking like this is great. But the reality is now the bar is just so much higher, and so you're going to chase that. Your investors want, I don't know, 5, 10x on that money, and so like, what are you going to do to get there? And so you could fall into a trap by raising that really high-priced round and moving a little bit too aggressively, with the VCs as you have a ton of attention on you.
To that point, I think one of my friends works at, I forget the name of the company, but they just released a report today that said IPOs are back, but that means maybe we're having 14 IPOs in tech so far this year that are both like slated and have occurred, and 900 some odd unicorns that are just sitting on the books at valuations that are stale, that probably don't even exist anymore. And so how are we actually being really thoughtful about repricing, recapping, being nimble? Like, I think there's just so much more opportunity to create real value in this ecosystem now. And so how are we taking advantage of it?
One sentence on top of that to build on that. There's an expectation that at IPO you get your money out, and it's not the case. What typically happens at IPO is there's a lockup, and most firms have followed Andreessen's lead and are now registered as RIAs, and they may choose to hold back the stock because they're on the board and they know that there's earnings coming and what have you. So you may be able to get some form of liquidity, but it's not necessarily an automatic fix for the liquidity issue that we're starting to see some IPOs. And certainly 14 is not going to solve it with 1,000 plus other unicorns, but it's a start.
The other topic I don't think we mentioned though is like the M&A side of things too, and I've seen a lot of firms bring M&A capabilities in-house and actually take a much more active role in their portfolio. And so I think firms are getting creative, founders are getting creative, but the discussion of what the exit environment looks like is today it's like IPO is hardly on the table. It's how can we think of all these other options of strategic acquirers, secondaries, and any other type of financing.
Interesting. Thanks for that addition. Technically, we're out of time, but I do have one final question. If we want to call it a lightning round, we can do that. And I do appreciate you sticking around, so we won't keep you any longer than we need to. But I did want to ask everyone, and Sydney, perhaps we could start with you to finish things off. If there's one area of fintech that you think is particularly underappreciated, underfunded, what area would that be?
Oh man, that's such a great question. We are right now actually really excited about where fintech and climate intersect. And so how are we investing in fintech solutions that are allowing us to be more climate resilient as communities, given that climate change is already here. It's not in some future time, it's right now. How are we actually building insurance products that make sense for homes that are in fire-prone areas? How are we thinking about just the whole stack? I think needs to be rethought. And so it's been fun to see what founders are building here and start to make some plays here actually alongside AmFam.
Excellent. Mike?
So I mentioned a little bit earlier, but for the last 5 years or so, it's been tough for consumer fintech and it's been tough for lending. Part of that is VC, like any community, can fall, subject to groupthink, and some people start to say, yeah, consumer fintech, we're not doing that anymore. We're not going to do balance sheet lending anymore, which I always thought was crazy because if you look at the big public fintech companies, Affirm, SoFi, Robinhood, Coinbase, what do they all have in common? They're all consumer-focused lenders. So I would say it's coming back, which is exciting, but I think it's still underserved by the market. And so you've had I think you've got a real opportunity with great catch on early, hitting scale, consumer fintech apps and lending firms.
Excellent. Tiana?
I won't add on to the climate financing that Sydney mentioned, but in all the conversations I've had in the last few months, I always hear investors are very interested in agentic payment infrastructure, and there just really has not been a lot of funding in that category. There's a few companies building for that, but I think it's every time I talk to somebody, it's that's top of their list, and so I think we were still at the really early stages of firms in that space, but definitely I think it'll be an exciting category.
Excellent, excellent. And John, what do you think?
So this is not a blueprint investment thesis. This is just what I hope to see as a consumer. So I'll throw it out there to the founders. But basically the financial services in, so I'll call it tax and wealth management, I think there's an opportunity to kind of combine some of these, I'd say more historically service-based solutions or offerings. So I'm hoping that somebody creates an awesome, direct consumer app for tax advisory and wealth management, and kind of branching off from there as your personal wealth manager in a box.
Fantastic. Excellent themes all. Well, again, we are out of time. I want to thank you all for some fascinating conversation, some great insights about what's going on in the market right now. Certainly things for us to be looking at over the balance of 2026. So again, thank you very much for being a part of our Investor All-Star panel.
Thank you, David.
And thank you all for being part of Finovate 2026.